What's up, everybody? Today we're talking about Crowdstrike Q1 2023 earnings. We're going to talk about the report. I'm going to tell you what I'm doing with my position in the portfolio. And then at the end of the video, I'm going to run through 3 potential return scenarios and how I think about the valuation of the stock. Here's the stock. Over the last week, the stock is up about 11%. That captures them reporting their earnings and the response of the stock. For today, they're down about 1.35%. And then if we just look at year to date, the stock is down almost 13%. It's doing a lot better than a lot of other high growth names, but it has recovered a lot recently. It was down to a low of 31%, down 31%, and it's recovered quite a bit. As you know, on this channel, I'm building a $1 million portfolio. I'm sharing every step of the way transparently and how I research these stocks and come to these conclusions. Here's a look at the portfolio performance. We've got about $55,000 in the portfolio. We have put in almost $65,000, so we're down $9,600. On the day, the portfolio is down about $1,500 or 2.5%. Here are the positions and position sizes. So Crowdstrike, number 1 position, it's about a $9,300 position. And then you can take a look, screenshot it if you want, and check out the rest of the positions in the portfolio. No big changes if you've been following. Right now, let's get into Crowdstrike's earnings results. This is from my email newsletter. I will provide a link to this in the description so you can go back and look at this entire write-up and all these charts and everything. So the bottom line up front, the earnings were strong and the thesis is still intact. I would look at any sell-offs as an opportunity for investors to build a position if they want to make it larger. Shares are down about 18% year to date. So that was as of this writing. It's a few days old, 18%, 13%, whatever. The next 12 months price sales ratio was down from 39 in July to 17 today. And so that's looking at a fiscal year 2023 revenue of $2.15 billion. That puts it at that forward price sales ratio of 17. And then we look at the fiscal year 2024 revenue of $2.98 billion, gets you to a price sales multiple of 12.6 out to fiscal year 2024. So that's a key. I am a long-term investor. I am not looking for day trades. I'm not looking for short-term, and I have no idea what these stocks are going to do over the short term. I have no idea what they're going to do over the long term. I just think I own good companies. I think they're going to do better. Here's a glance at the results. They had $1.92 billion in annual recurring revenue. ARR was up 61% year over year, 64% subscription revenue year over year growth, $83 million in non-GAAP operating profit, $158 million in free cash flow. That puts them at a cash flow rule of 40 of 93. The rule of 40 is a way to judge the strength of a company or the quality of a company based off revenue growth plus either free cash flow or operating margin. So the cash flow rule of 40 is looking at the free cash flow margin plus revenue growth. 93 is very high, and I'm happy with that. 40 is good. 93 is amazing. 17,945 subscription customers, and 71% of the subscription customers have 4 or more modules. Crowdstrike offers multiple different modules or services or products that customers can subscribe to. As customers adopt more modules, they spend more money and they tend to stay on the platform longer. So as we see them adopt 4 and 5 and 6 modules, that's great for Crowdstrike's business. In the quarter, they had $487.8 million in revenue. That beat management's guidance by $25 million and analyst expectations by $23 million. The non-GAAP earnings per share was 31 cents, which beat analyst expectations by 8 cents. Their cash flow, net cash generated from operations, was $215 million compared to $147.5 million in the first quarter of last year. And their free cash flow was $157.5 million compared to $117 million last year. So we'd love to see that cash flow increasing. Cash and cash equivalents, $2.15 billion. This company has a strong balance sheet. Who knows what's going to happen with a recession or inflation or whatever over the short term. I am of the belief that companies are going to continue to need security coverage and specifically endpoint solutions that Crowdstrike specializes in. And so even if they do take a revenue hit over the short term, I think they have the balance sheet to withstand as a company and then come out stronger on the other side. And so sure, maybe the stock goes down, but I think they're building the high quality business, and their numbers prove that they're important and customers are sticking with them. So on the backside of a recession and with their balance sheet, I think they would actually take market share and become stronger and be a stronger company in the future. That doesn't speak to what might happen in 6 months or a year. I don't know, and no one else does. If they tell you they do, unsubscribe, don't listen to them anymore. The other thing we want to pay attention to with CrowdStrike and other software companies is customer retention and expansion. So this is a term called the dollar-based retention rate. If it is over 100%, that means customers spend more in future years than they did in the previous year. So for example, in the most recent quarter, it was 123.9%. That means customers on average spent 24% more this year than they spent last year. You can look at that as almost like free marketing or free growth, that they don't have to then go out and sign up new customers. They're getting 24% revenue growth just from their existing customers, which is great. We'll talk about some business highlights, and then if you want to check out the rest of the report, you can check out the first link in the description. They added 1,620 new subscription customers. That got them to 17,945, which was 57% growth. Talk about their outlook. Second quarter revenue outlook of $515 million and non-GAAP earnings per share of 28 cents. So when they come to report next quarter, these are the numbers that analysts are going to be paying attention to, and we'll cover it right here on the channel. Make sure you like this video to help people find it, and then subscribe to the channel so you never miss an update on these awesome growth stocks or my portfolio. Fiscal year 2023 revenue, they guided to $2.198 billion, which was $50 million above their previous guidance. And so we like to see that from management. Let's jump over to ratings from different services. So this is Seeking Alpha. You've probably heard of it. They provide a ratings summary. I don't always follow them, but I just like to think about them. And then I come up with my own solutions, which I'll share my scenarios at the end of the video. The Seeking Alpha authors call it a hold with a rating of 3.3. Wall Street, so Seeking Alpha also gathers data from Wall Street analysts. They call it a strong buy with a rating of 4.7. And then quantitatively, that's taking in all of these factor grades, I believe, they have it at a hold of 3.26. And you can see that these factor grades have good ratings in growth and profitability and momentum and revisions, but the valuation is an F, which is probably killing that overall rating. So that's the rating it gets from Seeking Alpha. Jumping over to Morningstar. CrowdStrike has a 4-star rating from Morningstar. It shows that Morningstar believes their fair value is 225, meaning it's at a 21% discount at the last closing price of 178. They did a write-up. They said that they continued their impressive growth streak in Q1 and shares are undervalued to their $225 fair value. They give them an economic moat of narrow and capital allocation of exemplary. That's because of that balance sheet that I talked about. Just for your reference, a 1-star price, meaning they think it's overvalued, would be shares at $348. And then a 5-star price, meaning it's very undervalued, significantly undervalued, shares would be down to 135. That's only like 20% lower from here. Let's jump into this spreadsheet that I provide to subscribers of my email newsletter. Hit the second link in the description to get access to these resources, and then you can reference the spreadsheets and then my return scenarios, which I'm about to share. So looking out to fiscal year 2027, analysts are expecting revenue for fiscal year 2023 to be 52%, 35% in fiscal year 24, 28% in 25. They've got it at 14 and 26, which I think that's a typo or a misrepresentation, then 51%. In my scenario, I actually kept it around 28% through fiscal year 27. So we'll talk about that in a minute. But here are the return scenarios. So what I did was I went to Fast Graphs, which I've showed you before. It's a charting service essentially, and I put in 3 different scenarios based on today's share price and fiscal year 2028 revenue expectations. The revenue is going to be different than what analysts are expecting. They're going to be way low or way high. We don't know. This is just a reference point. And then I looked at a price sales ratio of 7, 10, and 13, which is down significantly from the price sales ratio today. So at a price to sales ratio of 13 in fiscal year 2028, the share price would be $468, which is a price gain of $289 a share from today's price. That gives you a total return of 162%. and then an annualized return of about 18.5, 19%. As a reminder, the S&P 500 generally returns 8 to 10% a year. This is not a forecasted return. This is just a potential scenario and how I think about the stock. I love owning the stock given that potential scenario, but that's a price sales ratio of 13, which might be high. Bring it down to 10, same setup. We're looking at a total return of 100% and then an annualized return of 13%. So that's not super amazing if we think about what some of the returns in 2020 and 21 were, but compared to the average S&P 500 return of 8 to 10%, we're still beating it by 30 to 50% per year. So I'd be happy with that. Then even more conservatively, bringing it down to a price sales ratio of 7, you're looking at an annualized rate of return of 6% for about a 41% total return. And that is below the S&P 500 average return, but that's taking in significant contraction in the price to sales multiple. And so I think it's a pretty conservative scenario. It could go way lower than that, but I also like to think about scenarios like that. And so as you can see, this is looking at revenue growth of 49%, 35%, 29, 29, 30, and 28. So basically keeping it right around that 29 to 28% level. That's all we've got for today. Make sure you like the video, help others find it, and then subscribe to the channel so you never miss an update. Next video we're doing is on GitLab's earnings.